Are you ready to take the plunge and buy your dream home? But hold on, before you start house hunting, it's crucial to answer this one question. What mortgage can I afford? Let's explore the key factors to consider when determining your budget for buying a home. See, buying a home is a major decision, and one of the biggest factors to consider is how much mortgage you can actually afford. It's important to take into account your income, your monthly expenses, your credit score, and your debt to income ratio when determining how much house you can afford. Number one, your income. It's probably the most important factor in determining how much mortgage you can actually afford. See, lenders typically want to see your monthly mortgage payment, including principal, interest, taxes, and insurance, not exceed 28% of your gross monthly income. For example, if you make, let's say, $5,000 per month, your monthly mortgage payment should not exceed $1,400. Now, disclaimer, that is for some lenders, not all. A lot of lenders nowadays are a lot more aggressive.
You don't scare me!
And they allow your front end ratio to be at least, I want to say, a 47 or 48% with FHA. That means it can be a lot higher than the example that I just gave you. But that is not typical of all lenders. So this is an example. Do not quote me on this and do not come looking for me. For example, I go much higher, but some lenders can go, they could be a lot stricter.
What the fuck was that?
Stricter. Now, number two, expenses. In addition to your income, you need to consider your monthly expenses when figuring out what mortgage you can afford. These things include things like your car payment, which we tend to forget about, your credit card, your student debt, your bills. When you're buying a house, your expenses are still going to be there. One major expense that I tend to forget a lot about is your wife. Because if you have a wife or a girlfriend, you know you're spending money. So please, you want to make sure you have enough money left over after paying your monthly expenses, which is right there, to still cover your mortgage payment. Number three, your credit score. Your credit score is an important factor in determining how much mortgage you can afford. The reason being is a higher credit score can actually help you qualify for a lower interest. And as you guys know, the lower your interest, the more money you save and the more money you can put towards your monthly mortgage payment. Now, if you want to know more about interest and how payments work, check out my last video, which Rafa, right up here. Boom, boom. Now that you have that information, we're going to talk about the next thing, which is your debt to income ratio. Lenders look at your debt to income ratio when they're calculating on determining how much money you can actually put towards your mortgage payment. So you have your expenses already. So we're going to look at your expenses. We're also going to look at your income, and we're going to come up with what your debt to income ratio is. Typically, we like to see it below 36%. Now, granted, this isn't for all lenders. This is an example, but the lower it is, the better. If it's high, we may tell you, hey, you need to pay down some of your debt so your debt to income ratio is better, and we can then give you more monthly money to put towards your mortgage. Because if you have less debt, then we can take more of your income and put it towards the payments of your house, which is going to help you. Or you can consider getting a smaller mortgage because that's going to make a difference. Number five, other financial goals. It's important to think about what else are you investing your money in. Are you trying to buy real estate? Are you buying stocks? What else are you going to be doing if you're spending your monthly money on this house payment? Are you losing it in other factors, other things that your money could be put in? So quick story, and the reason why I say this is so important. When I was buying my house, well, when my wife and I was getting a house, we did not consider our the main question, what mortgage can I afford? Instead, we looked at our income and we fell in love with a house. They was like, oh, you can get approved for this much. And we said, okay, we bought at the top of our pre-approval, which in hindsight created us to be what's called house broke. We bought what we could afford based off our income and not what we could afford based off of all our expenses and things that we knew we wanted to do, like still travel, eat out, and the monthly maintenance fee of having a wife. Now, as you guys know, when you're buying a house, you have to change some of your tendencies or your habits that you tend to do. But you don't want to change everything. Like, I still like vacationing and we still go on it. But due to that situation, it caused us to figure out other ways to make income. Well, it worked for us, but it doesn't always work for everyone. So my big point of this story, the moral of it is, ask yourself, what mortgage can I afford? And look at not only your expenses, look at your other hidden costs that are associated with it. And do not forget putting money aside for your financial goals. And once you do that, I only want you to try to stay within 36%. I know it sounds crazy, but the least amount of money you're putting towards the mortgage, the more money you have to build a future and generational wealth. Now, I gave you a lot of information. I know a lot of you are confused, but this is all going to make a big difference when the mortgage fits into your budget and it doesn't cost you to go house broke. Thank me later. Put in the comment section if you want me to talk about this topic more, or if you just want a story time. This is the real Mr. Marcel, over and out.